What is going on, guys? Welcome back to the channel. Very happy to have you guys here. If it's your first time watching, hit the like button. If you're a second time viewer, make sure you hit the subscribe button if you're not already subscribed. Today, I am going to be breaking down to you guys my latest winning trade right here, line 30 on my live trading Excel sheet. We finally got a winner after two previous losses and a break even. And this winner is, significant because if you look at our equity curve here, it actually brought our equity curve to all-time highs. So this is what the equity curve looked like before this trade ever took place. You see, it was kind of like a higher low. And we didn't really know if our next trade was going to be a loser and it was going to bring it down further, or the next trade was going to win and it was going to bring it down or up higher. This trade got me 4.5 R, which made the equity curve bounce up into new territory, which is always great to see because February showed us, if I scroll down here, we took two trades in February. And it's important to note because although we only took two trades, we still had a profitable month. And it goes to show that you don't have to be doing much in a given month to have a profitable month and to make money. So what I'm going to break down to you guys is the misconception that the amount of money you make in the market is correlated with the amount of action you take. A lot of beginner traders, a lot of people who are inexperienced in the market or don't really know what creates a profitable system, they will force a lot of things on any given day, and they will find multiple ways to force anything. Meaning that on every single day of the month, they are constantly looking for ways to get involved in the market. And they are taking multiple things that could be deemed as random just to get involved and just to chase that opportunity to make money. That's what they are chasing. They're chasing that feeling of what it feels like to make money, and they're almost gambling and chasing that high that they get through random trades. And it's important to note that when you guys actually look at what my February looked like, it was filled with inaction. And if I even go back to January, you see here that it was another month. I had slightly more trades in January, but it was still filled with a lot of inaction. But yet it was a profitable month. I had a winning trade that netted me 5R, and then I had 3 break evens and 1 loss. So that ultimately still led to a profitable month. And if we go back to December of 2025, you guys will see here that this was still a month I was profitable with 3 trades. 3 days in a row, I took 1 trade in December. And it was still a profitable month, even though for 75% of the month, I did absolutely nothing. So what I'm going to explain to you guys here, and get out your notebooks because this is important to understand, especially as a trader and someone who wants to go full time, day trading that is. The amount of action you take in the market does not determine your profitability. And the reason why a lot of people think it does is due to their conditioning of how the world usually rewards us. So if we think about it, we go to school, we do our homework, and that input we do, that studying, that grinding, the ability to complete homework every single day is rewarded with us at the end of the week or at the end of the semester with a test or an exam, right? So we know that the amount of work we're putting in, the input we're putting in, we have a set timeline on when we can expect the reward. Now, if you think of just working any normal job, any sort of career, you work a 9 to 5, you are given a base salary per hour. And you know that the amount of work you do today is going to equate to this amount of money per day. And this amount of money per day over your 1 week or 2 week pay period will net me this. And this is what I can expect through all the inputs I'm doing in the previous 1 to 2 week pay period. So you have that defined reward that you know you are going to get. Where in trading, the amount of action you take has nothing to do with the amount of money you are able to make and the amount of money you are going to make. Because if that was the case, well, I just showed you guys my February and my January. If that was the case, and you guys see here for 75% of the days I'm doing nothing, but I still ended up with a profitable month, well, that should tell you guys right away that the amount you do doesn't necessarily mean that you're going to be profitable, or the amount of action you take, that is, I'm sorry. So what you can take from this is that there's a lot of inaction involved in profitable day trading. And a lot of inaction means on a lot of these days in February, for example, you are showing up on every single day. You are opening the markets. You're seeing if anything's there. And a lot of the times you're stepping away. And you're stepping away because there's simply nothing to take. Nothing's clear. Nothing's met your rules. And if you do force something in those times, well, oftentimes, one, your confidence is going to be lower because now you've entered the realm of doing random things. And then two, you'll probably end up taking a loss because oftentimes when something's not clear in the market, it's a clear sign to stay out. And if you force things in those times, well, those are times where losses come more frequently. So for a beginner trader who's maybe still learning or in the process of learning through or going through a lot of those trials and tribulations, they will be met with a lot of days where they find themselves taking action and beginning or participating in trades by pressing the buy or sell button. And that, depending, obviously it's like a case by case scenario. I'm sure some people will go on a major win streak and feel like the amount of actions they're taking, the more actions they take, the more winners they're getting. And it's kind of like some parabolic high that they're living for a short duration because those times always come to an end. But what they will find is their ability to actually create consistency in the market will be, I guess, torn apart a little bit, because a large part of being consistent in the markets and extracting, money from the markets in a positive way, ultimately leading to positive expected value, it's required for you guys to sit on the sidelines on most days, because the truth is a lot of times the markets aren't in a clear environment, aren't showing any clear setups, and there's nothing to trade, which you guys will obviously see here on most days. That's the case for me. And I have a defined system with rules that I obey, and that I'm not going to force anything that my rules wouldn't prohibit or would prohibit me to be in. So you guys will see that through all that inaction here on most days, the 1 to 2 days I've traded in the month has still created me some sort of reward. And that reward wasn't given to me by showing up to the markets every single day and slamming my buy button on assets. It was given to me by being able to sit on the sidelines, go through a lot of markets like this, and simply say no. And your ability to say no in the markets when the markets aren't clear will be the exact reason why you don't take trades on a lot of days. And the reason you're not taking trades, or your ability not to take trades on a lot of days, will actually save you from taking a lot of losses. So that's something I want to get out of the air right away. February, I took 2 trades. I'm not showing up every single day because, once again, the amount of action you take in the market does not determine how profitable you are. But with all that being said, we are going to open up GLW here. This is the asset I traded that got me this beautiful winner you guys see right here, which once again brought my equity curve to these all-time highs. And what I'm going to do is, we're obviously going to do a breakdown. I'm going to show you guys the concepts or what I saw in the story or the context of the trade that allowed me to become interested. And then from that moment I became interested, what I actually started to look for. And then what I started to look for becoming true and gaining or allowing me to enter the market, and how I manage that position. So this is what I saw on my highest time frame. So there's a lot of action here on the weekly time frame, but if you guys like just from any perspective, if you guys were to buy or sell this market based off just what you see right here, what would you do? There is one answer I'm leaning towards more than the other, but just based off what you see right here, do you think it's better to buy the market or sell the market? This is how simple analyzing an asset could be. If you just want to like dumb it down to its like most basic terms, when you open something, does it look like it's being bought or being sold? A tip, which a lot of traders have probably heard this, if something's heading towards the top right side of your screen, you probably want to buy it. And if it's heading to the bottom right side of your screen, well, you probably want to sell it, because oftentimes when something's heading down here, it's losing a lot of its value. And if I scroll down here, you guys will see that if I just cut it off right here, it's going down to the bottom right of the screen, and you see buyers just get wrecked. But on this side, you see the buyers are flourishing while the sellers are getting wrecked, because this is just heading to the top right of our screen here. So let me make sure I want to make sure the trade is on there. I don't know why it's not showing. Okay, there we go. So just from like a zoomed out perspective, I want to buy this market. And now what I'm looking for once I realize I want to buy the market is I'm looking for a trend on my weekly time frame. And we know a trend is going to look something like this. Now, if I know my higher time frame is in a trend, then I know on a higher time horizon, right? Because my highest time frame is the weekly, and I know if my weekly is in a trending environment like this, well, in real life time, I know that if this area or this structure was made out of candles like it is down here, this is going to equate to a lot of time, right? So why that's important? It's because you're going to have an idea of how long a trend can actually last when you look at a lot of these areas where you do have a trend on whatever time frame. It doesn't matter. For this example, the trend happened on a weekly time frame. So if I actually count how many weekly candles this trend was made up out of, it was 65 weekly candles, which was 456 days. So like a year and a half, we'll call it. So this trend lasted a year and a half. So right away, I know, or I can assume that if my weekly's in a trend, well, then it can actually trend for a very long time in real life time, right? Because charts, especially when you're back testing, you can zoom through data and it doesn't feel like the amount of time it actually is. And what I mean by that is if you're just testing and you're like, oh, like I want to go down here and then I just want to play some bars like this. Well, you've just gone through 10 weeks of data in literally 2 seconds, right? So when I refer to real lifetime, I want you guys to like forget about the charts, forget about how fast you can play data, because this data that you're playing out in 2 to 3 seconds actually takes multiple weeks to play out, especially if you're on that higher time frame, right? If you're on the monthly time frame, candles even take longer to play out and trends will last even longer. Now, so what I liked about this chart is that I did identify that a weekly trend had started down here. That was perfect. I was like, okay, shoot, the weekly has shown its ability to move bullish. And I want to trade bullish because I know if I zoom out, this chart over since 2006 area has only shown its ability to keep reaching up. Although there's been dips in the price, it's only shown that its ability, or it's only shown that it's had an ability to keep pushing up after its downward swings. So after this big push up, what I'm going to assume in my head is that, okay, boom, I know trends can't last forever. So although this trend is playing out, at some point it's going to come to rest and my weekly time frame is going to move bearish. Well, what does it mean when a time frame moves bearish? Well, it means that it's going from a trending environment, so upwards, and it's going to start going downwards. This is a transition in the market, and that transition usually happens when a point of structure like this one here is broken down below. And what you guys will see here is that's exactly what happens here. So this point in structure, this higher low, it actually gets broken down through right here. So what can I expect, or what I expect to come out of that is, okay, price is no longer moving up. It's actually started to move down below key points in the market. So possibly this trend has come to an end, and that's okay. Trends do come to an end. And no, I did not mean to rhyme that. But when that trend does come to an end, I know that since the bullish trend is over, price is moving bearish, and I don't want to trade bearish, because we know if we zoom out to the highest level, this has only shown its ability to move up. Although it's had steep dips, smaller dips, it keeps moving upwards. And if I were to try and like make it clear for you guys here, I would just do something like this, right? And then even if you scroll to the left here, even on this side of price, 1975 to 2000, before this big spike down, you see it only had an ability to move upwards. So when price moves from a bullish trend on a higher time frame or transitions to bearish, I know that I am potentially going to be sitting out for a longer period of time, because since this breakdown's happening on the weekly time frame, I'm going to have to wait a bunch of weekly candles, in this case 8 weekly, or like 8 to 10 weekly candles, which is 70 days, just for the market to go back into a trending environment. So what I mean by go back into a trending environment to the bullish side is for this second rectangle to actually come into play here, price had to go through this period that I'm going to mark red. And the difference between these areas here, between the clear rectangles that outline or go over these bullish trends and the red rectangle in the middle, well, the red rectangle in the middle, if you were to spot out a key difference, the simplest version or simplest thing I could point out would be that price is moving down. Whereas in these boxes, price is moving up. So what I know right off the bat is that, okay, when price breaks down, I need to wait for price to go back bullish. Because one, if price breaks back bullish, I know that it's now in alignment on that larger scale since like 1975, where price has only shown its ability to move bullish over decade, over decade, over decade. So boom, we know once price turns bearish, it's not in alignment with what the overall chart has been doing for decades. Now, when price goes back bullish here, it's very important to understand that you are now in alignment with the overall trend on the highest time frame, right? And what I mean by that is that its ability to continue when it's in alignment on a higher fractal, meaning a higher time frame, when it's in alignment with its, I guess you could say, higher power, because the charts, the higher time frames control the lower time frames, and the lower time frames work themselves to complete the story of that higher time frame. And what we see here is the weekly time frame has now shown its ability to move bullish again after this bearish push. And when it moves bullish, we understand that at the highest level of this chart, it's now in alignment with what it's been doing since almost the start of time, or start of this asset's life, GLW, whatever the heck GLW is, right? So once we understand where we are, what the chart wants to do, and when it's not doing that thing like it's doing here, when it's not moving bullish and it's moving downwards, we can identify the areas where we want to stay out and the areas we want to get involved. So that price breaks down on the weekly and then starts this bullish trend. Now, this is where it starts getting interesting, because now that we know where we are, we know what the chart wants to do, or have an idea of what the chart wants to do. And once the chart shows us it's fulfilling what we think it wants to do, then we can confirm the bias further. And what I mean when I say confirm the bias further, I mean that we can start moving down the fractals, also known as time frames, to make sure now these lower time frames like the daily and the 1 hour and anything lower are now going to align with our weekly time frame, because the weekly time frame is now in an environment where it's entered a bullish trend. And when that higher time frame is in a bullish trend, we know that the lower time frames have to work with the higher time frame, and the lower time frame is going to be acting in a way where it's looking to fulfill what the higher time frame wants to do. So if the higher time frame on the weekly wants to continue putting in higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, well then if I drag this to the side, I know the lower time frames on the inside of this structure are going to be moving bullish, and then they're going to break down, and then they're going to move back bullish. They're going to break down, they're going to move back bullish. And what they're doing is they're creating the higher highs and higher lows of a higher time frame by completing its own structure legs on the inside. And it's a little bit of a kind of a mental hurdle, but the more you look at it, the more you'll actually get prone to spotting it. Because if I go down here, just to show you guys, so here are my weekly labels. Why I labeled them in numbers, it means that once we break and create a higher high, this is the first higher high, this is the second higher high, this is the third higher high, this is the fourth higher high, this is the fifth higher high. And once price breaks down, the count restarts. So this would be the first break upwards. We always label the break outside of the roof. So I would call this area like a roof. The break out of the roof would be the accumulation break. And then this would be the first high. I don't know why I have it as a 2. This would be the first high. And then this would also be the first high. I would identify this area as 1 instead of it being 2 separate, just because the way price moved in this area here, it created this higher low, and then it didn't move high enough or further enough from this previous point right here for me to consider it a different structure leg. So that's just a personal rule that I made for myself when identifying structure legs. You can use it if you want. I can even speak more about it or more in depth about it in a different video, but that's exactly how I label my structure. And then why some labels may be the same as the previous label is because I still see them as part of the same move, meaning that this higher high and this higher high are pretty much like the same thing, but this higher high up here and these higher highs down here wouldn't be grouped together, right? Because this high is way further away than the previous highs here. So let me take a drink. So when price makes this big break up into this bullish trend on the weekly time frame, I now allow myself to drop down inside these areas here, on my daily time frame, which I will pop the labels up for right now. So what I see on the daily time frame is price makes this big uptrend, creating that higher high on the weekly. We know that's the weekly higher high because you see the label right here. And once it makes that higher high, it actually breaks down. So it breaks down into this bearish structure here, which we know we don't want to trade already, because we know when we zoom out on the highest fractal, it's moving bullish, right? It's moving upwards. So anything that shows it wants to move lower, we're just ignoring. We're not getting involved in it. It's literally as simple as that. If structure is moving down on any time frame and we know we want to trade it up, we just ignore it. And you'll see here, it breaks down past a previous point, which we would call a significant point here. It breaks down and then it kind of plays around in this area here. And then as soon as you know it, it actually breaks back up through this roof, you can call it. I actually made a video. My last video goes over roofs and floors. We know a roof is, or the break past the roof means just price consolidated in an area like this, and then it makes a big break upwards. And when price makes that break upwards out of the roof, we expect it to continue. Sometimes it does fail down and go sideways or consolidate a little bit longer. So that's when we have a new roof drawn as such. And when price breaks this roof, we now expect price to go off in a trend. And that's exactly what happened on my daily time frame. So just so we're on the same page here, if I were to draw the areas of my daily trends, I would draw a box here before it breaks back down and moves sideways. And I would draw a box here. These boxes are in alignment with where the daily broke out of consolidations. When price breaks out of consolidations, we expect it to go. And what you'll see if I go back to the weekly time frame here is that, let me make this a little bit lighter. Price made those breaks down and then broke past up, and that's when we expected this trend. So when I move down to the daily time frame, price breaks down, right? Price moves up, breaks down, and then breaks past a lot of points in the market, and we expect a trend. Sometimes that trend doesn't want to go and it falls back down. It gets stuck, multiple point rejections off the same area, meaning consolidation. Price is struggling to break past a certain point. And then once it breaks past that point, well, we expect a trend. And that's exactly what we got. And when that trend starts, we now know, we can now say to ourselves, okay, so I know I'm inside a weekly bullish trend, and now my daily time frame inside that higher time frame weekly leg is also proving bullish structure. And I know my daily and my weekly are both bullish now, which is in alignment with the zoomed out version of this whole asset, which has only been really moving bullish since 1975. So something tells me that for some reason, the market makers or whoever has just been buying this asset for the most part ever since it actually was released on the stock market exchanges. So why wouldn't I trade it bullish, or why wouldn't I at least start looking to see if I can get bullish opportunities to be able to get involved on what seems to be the direction that smart money or the composite operator is moving this chart. So when price breaks into this bullish trend on the daily time frame, well, now I'm actually intrigued because stuff is starting to align and things are starting to trend together, right? We take these time frames and we mash them together. So we know when this daily starts to trend, all the time frames are now working together. And that's good for us because when we enter in a market, we want to make sure the context or the story is all fulfilling the same ending, you could call it, if that makes sense. Everything's working together to get you to the end product, and the end product in this case would be an entry. Now, when this daily starts moving upwards, we see the daily's accumulation break here. This is the first break. This was the first high to run. This was the second high to run. This was the third higher high to run. And this was the fourth higher high to run. Now you see, I actually showed up to this market late, right? There were a lot of opportunities to get involved in some of these lower points, but a part of my rule system here is that on my daily and my weekly time frame, I can't trade past the fourth high. So I can trade inside the fourth high, but if price came down here like this and then created another higher low, then did something like that, I can't trade inside here. I only trade, the last part I'm allowed to trade in a trend is the delivery of the fourth highest high, which would be right in here. So there were opportunities here lower, and I'm sure if you went down to a lower time frame, you could see there were some entries you could get involved. There were some points of entry you can get involved in here and here and here and here and here. Now it may be harder for some of you guys to spot those opportunities, but since I'm so accustomed to the way I view markets, it's a little bit easier for me to just go in on something and be like, oh, there was definitely entries like inside these deep areas here before this weekly trend fully played out. But to me, I showed up to the market much later, which ended up making me miss some of these lower points of entry that could have ended up being huge runners that just go on and on and on. And if I got entered down in these areas here, well, there's a chance that I could have actually potentially been in this trade or held a trade for much longer. But that's not a part of my rules, so I'm not really playing the what if game here. But you guys can see, even though I showed up to the market late in what seemed to be like, or 1, 2, 3, 4, 5, 6, 7 candles up on the weekly time frame, I was getting to a point in the market where I thought this was overextended. And I thought that this market wasn't going to continue up for much longer before it broke down. But what's important is that my rule said I can still trade in the delivery of the fourth high on the daily and the weekly. So that's what I did. So when this high got created here on the daily time frame, I actually dropped down to my weekly, or sorry, my 1 hour time frame. And what I needed to see is I needed to see some sort of reset. I needed to let the market come to a pause because the market had just fulfilled this higher low to higher high structure formation. And now on the daily time frame, I wanted to see that pullback to make that higher low before I traded the anticipation of that higher high. So once this happens, I know for that to happen, my 1 hour time frame needs to break down and do something like this. So that's exactly what I was waiting for. And you guys will see here, that's exactly what price does. Now it does a version of that. So you see what I drew right here and then what price actually did were two different things. It's never going to be perfect. Areas of consolidation, so areas where the market starts moving sideways in an area of consolidation where it builds those points on the top side that keep getting rejected, then those points on the bottom side that keep getting rejected, like right here, right there, right there, right there, then on the top side right there, right there, right there, and there. It's creating a roof and a floor. And once price breaks out of that roof and floor, like it does right here to the roof, well, similar to what I explained to you guys on the daily time frame, that's when we expect price to go into these trending environments, right? So down here, when the 1 hour broke through this roof, this area of consolidation, sideways price action, where price was literally doing nothing, just showed it wanted to chop back and forth. Well, we finally got that break, right? So we got that break right here. So right when I got this break, I was like, oh shoot, this is a really strong break. You can actually tell from the candle just how strong this push was and that a lot of money got involved in some deep areas here. So once I knew that, I became interested because I know what I can expect after price breaks out of that consolidation is I'm now expecting a trend. Okay, so when that trend happens, I know that is now involved, or sorry, I know it's now in line with my daily trend and my weekly trend. Everything is trending. Everything is moving bullish. Everything has moved from this area where price made a bullish trending leg. It broke down and then regained its momentum to the bullish side. And then we further found points of structure on those higher time frames where we dropped down to lower time frames like the daily here, and we then confirmed that exact same thing. We're like, oh, price came from a trending environment, broke down, moved out of an area of consolidation, maybe broke down again, moved out of an area of consolidation, broke through the roof of this consolidation right here, and then began a trending environment. Okay, perfect. Inside that trending environment on the daily time frame, well, we found a point of structure here that we wanted to trade the delivery of. So I dropped down on my 1 hour, and I see that the 1 hour time frame was doing the exact same thing as the weekly and the daily. It started to trend, it came to a pause, created an area of consolidation, broke past that area, and has now started to make that trend that we expect. And when that trend starts, so I'll put on my labels here, we had the first break signaling accumulation through this area here. And then we had the first high to be ran, which gets ran through. And then we have a second high formed somewhere here. And this is actually the high I traded the delivery out of. So you'll see here, we have the structure on the 1 hour creating perfect structure. You can see the pushes to the top side are very impulsive. They're very clean. It's not a wiki chart. So I'm intrigued with the clarity this asset is providing me on the 1 hour especially, but the daily and the weekly time frame have also gave us clarity on what we can expect, meaning that we can expect bullishness to the top side just based off what the asset's actually doing. It's creating moves up, consolidating sideways, and then furthering those moves upwards, shown on every single time frame I've just walked you guys through in the past 3.5 minutes here. So once price makes these big trends or big pushes in this hourly trend, I became interested in this area right here, because I know in this area right here, it's going to be doing the exact same thing where price moves from a trending environment, breaks down, and when price breaks down, I expect an area of consolidation that price will break out of like that, and it's going to create a high. So what I do is I enter on the 10-minute time frame. So my time frame sequence again is the weekly, the daily, the 1 hour, then the 10-minute. And when that 10-minute finally breaks down, how I enter my trade is I wait for a big push. So I wait for a big push like this. Big push. And then I wait for a retracement down to the moving averages. So a big push, a retracement. Now, what do I identify as a retracement? Well, a retracement would be for me a candle that takes the low of a previous candle after a sequence of candles in the same direction. So let me break that down. So we have a sequence of up candles in a row, creating this big push out of this roof here. And then we have a down candle, and then this down candle takes the low, it breaks down the low, breaks past down the low of the candle before it after this sequence of up candles. So that's what I would identify as a retracement. And then once that retracement happens, with that retracement, you get a high. So what's a high in the market? Well, a high is a point with a lower point on each side of it. So this candle right here would be the high, because on each side of that candle, there's a candle with a lower high on either side. So once I get that retracement, usually a retracement and a high in the market and a retracement, one comes before the other. So oftentimes you'll get that high formed right here, and then a retracement will come next. So after that retracement, you're going to buy stop the high. So what that means is when price is right here and price moves from that bullish environment, that bullish trending environment like so, it breaks down into this area of consolidation. and then breaks past that area of consolidation and creates that first high, we want to place our buy stop above the high of the first push out of the accumulation, because this break past the roof, all a break past the roof is an accumulation. So break past roof slash consolidation equals accumulation. So once we get those things here, let me make that a little bit longer so you can see it. Once we get that and we place this buy stop, we're simply just waiting for price to tap us in before price breaks down below the averages. So what that looks like is, I'll play the next couple candles here. On the next candle, price enters me in the trade right away. So I'm in this trade here. Now, if price did something like this, if price did something like this, and these averages were doing something like this, showing that this bullish leg has now retraced under these moving averages, I wouldn't trade it and the trade would be canceled, and it would be as simple as that. Why the moving averages are so important is because they show momentum. And if price fails the moving averages at this point, then my entry is not showing me momentum. And the best entries and the best trades come in high moments of momentum. So once price taps me in right away, I'm in the trade. This candle showed momentum. And all there was to do was manage the trade. So how I manage the trade, let me grab a little text bubble here. So I break even at 1-to-1. At 4 RR, I move my stop to 2 RR. Full profit at 5 RR. So I'll explain what all of this means. Point by point. The first one means that once price moves 1-to-1, meaning the same amount of distance from my entry to my stop loss would be my entry to my break even. So this would be 1-to-1. Once price gets there, I break even. So let's wait for price to get there. Boom. At this point, I was break even, risk free. My stop loss goes here. For the sake of the video, I'll keep it here. But just know at this point, I am now not going to take a loss on this trade. Now, the next thing I do is at 4 RR, I move my stop loss to 2 RR. So I'm going to keep this line here. Oh, sorry, I'm actually going to take this line. I'm going to make it red. This line is going to signal where my stop loss is. So at 1-to-1, my stop loss is right there at my entry. But when price makes its way up here, I will actually move my break even to 2 RR. Okay, so 2 RR, I'll move my break even right there at 4 RR. So price has to get to this higher black line or higher red line before I move my stop loss here. So move stop loss to here when price reaches higher boundary line. Okay, so let's see when price hits that. Plays around, takes off, and then hits that right there. Hits that right there. So not until this candle, my break even was down here, and then on this candle here, it got moved to 2 RR somewhere in this area here. Now, why I do this is because I like to trap price. So you guys will see here, the third thing is I take full profit at 5 RR. So my full profit is at 5 RR. You see the risk to reward ratio 4.99, same thing, 5 RR. So price has to get here for me to take my full profit. But you'll notice that my stop loss is now here. So my stop loss is here. So price at this point in time, it's either going to go up to this point and hit me out for my full take profit, or it's going to retrace down here and I'm at least going to walk away with 2 RR opposed to nothing. So it's just the way I like to take my partials. It's a way to trap price. I know that once price gets to 4 RR, I'm going to have a winning trade either way. It's just the matter of if I get a full 5 RR take profit, which would be up here, or a 2 RR take profit, which would be down here. So let's see what happens. Now this trade actually hit my take profit in after hours. So what I'm going to do here is I'm going to press this little button. I'm going to go to sessions and then extended trading hours. This is going to show us the market candles after 4:30 p.m. or sorry, after 4 p.m. So at this point here, the stock market closed and it was after hours. Then my take profit, my full TP got hit in after hours. So you'll see if I play the next couple candles here, it actually smacks it literally to the dot, like literally to the dot. Now I actually messed up this trade since like trading live is like somewhat new to me within like the past 9 or so months or whatever timeline it is. I didn't know that one, you could even execute orders past market close. And then if you do, it has to be a limit sell. So I wasn't able to get my full take profit off in time or close the position. So I ended up actually closing my position down like right around here. Right here is where I closed it. Even though it should have been closed right here, it was just a minor mistake I had made. Some things or some mistakes you have to account for in live trading that you won't necessarily experience in backtesting, because if this was backtesting, I would have just said, oh, boom, 5 RR. I can't account for the fact that, oh, like this actually got hit in after hours, and in after hours, like I'm not used to closing trades there, and I didn't know I had to do this and that just to be able to close my trade. And me doing all that ended up with me missing my take profit level by like a couple minutes, and now I'm losing out on like a half RR. So I ended up securing 4.5 RR on this opposed to 5 RR. Right, there's just some things you can't account for in backtesting that will happen to you trading live. But your system should be so profitable that those minor mistakes or things you miss live won't actually affect your equity curve in the long run. It'll already be accounted for. But yeah, without further ado, that is my full trade breakdown. I know it was kind of long, but I want to really give you guys the most in-depth version I can of the trade breakdown. If you learned anything or you grabbed one single nugget from this video, comment what that nugget was. If you made it this far into the video, you're a real one. If you're not subscribed to the channel, subscribe to the channel. Would love to have you here. And other than that, I'll see you guys in the next video. Peace.